Welcome back, everyone, for the keynote session. And it is a great pleasure to have Darrell Duffie from Stanford University with us. So Darrell doesn't need much introduction, but let me highlight two things from his long list of accomplishments. So on one hand, he has written books on measuring corporate default risk and how big banks fail. On the other hand, following the LIBOR scandal, he was appointed chair of the market participants group, which was actually charged with proposing reforms to LIBOR and Euribor and other interest rate benchmarks. And I'm saying this just to point out that Darrell has this impressive combination of academic excellence and also policy experience, which I think he puts him in a unique position to talk about what will talk in this keynote session, which is the performance of the U.S. Treasury markets and possibly redesigning them after the COVID-19 crisis. And don't just take it from me. Take it from Bloomberg, if you like. So this topic will actually be covered by Bloomberg later today. So if you ever hope to learn something before it's on Bloomberg, now is your chance. So with that, once again, thank you so much for joining us all the way from California. And the screen is yours, please.
Thank you so much, Michal. It's a great pleasure to speak at your FFI2, and thank you also, Björn, for hosting this meeting. As Michal said, I'm speaking from California. It's morning time here, and I know it's evening for most of you, and I'm sure you had a long day of engaging meetings. I was able to see some of the content, which looked really great, and I'm looking forward to the chance to talk to you today about some new work I'm doing, which is on the policy side, related to the design of the US Treasury market and how that market design was revealed to be not functional during March when the COVID crisis hit and news caused very large liquidation of Treasury positions. So I'm going to go through this at a measured pace, hoping that if I'm not clear or if you want to ask a question or comment, that Michal will relay to me, and I can stop and we'll try to address it as we go. It's a really exciting topic because it involves something that's of extreme importance actually to the global financial system and even the global macroeconomy, which is the foundation of financial markets in the Treasury market, which is probably the most important financial market in the world. It's why everybody waits for the Fed to make its decisions, because that sets the term structure of US rates. And trades are done in that market largely in treasuries. I'm going to walk through first 5 points what happened, or 4 points on what happened and what we can look forward to. And then I'm going to dive into the details. What happened is that in early March, the news about this COVID crisis started to get very serious. And this caused very significant liquidation of Treasury positions, both by large hedge funds and by significant real money investors like foreign central banks and other offshore investors. And these liquidations, the way that the market is currently designed, buyers had to be found for them, but before that could happen, the positions had to be absorbed onto the balance sheets of the intermediaries, which are largely primary dealers. So those primary dealer balance sheets had to handle the purchases of these treasuries and then the sale of them. And in the meantime, the treasuries are being warehoused on those balance sheets, which are limited in size, as I will emphasize, especially since the financial crisis of 2008, when regulation basically limited the ability or appetite for large banks to expand their balance sheets on short notice. So what happened? Well, the bid-offer spreads that were presented by dealers to their customers widened by a factor of 10 or more. I will show you some data. On the order book market for treasuries, which is also very large and populated mainly by dealers and interdealer brokers and high-frequency trading firms, order book depth dropped by, again, a factor of more than 10. The shape of the yield curve went out of joint. Basically, normally relatively smooth, it became disjointed, and particularly off-the-run treasuries became quite mispriced relative to on-run treasuries. And a basis exploded, the cash futures basis, which I'll talk about, which was a popular trade by large hedge funds for storing cash and for speculating on the cheapest to deliver treasuries for the futures market. That basis exploded. I'll come back to that. So all of the symptoms pointed to an inability of the market to digest these massive liquidation of treasury positions by large investors. When treasury yields fluctuated massively more than normal, record movements in the 30-year yield, for example, the Fed stepped in, and on the end of the week of March 11th and the beginning of the week of March 16th, the Fed decided that it would simply absorb all of these flows and more onto its own balance sheet so as to alleviate the limited balance sheets of the dealers. In the most aggressive monetary action or open market action ever by a central bank, the Fed purchased $1 trillion of US Treasuries in just a span of 3 weeks and then continued to purchase more. At the same time, the Fed offered unlimited financing to the dealers for their treasury inventories. And the Fed eventually exempted treasuries from one of the capital ratios that it imposes on bank balance sheets. And that leverage ratio rule, supplementary leverage ratio rule, which is a complicated story, was contributing to the limited balance sheet space, although not necessarily the major determinant.
If I may interrupt.
Yes, Mikhail.
So there's a question from the audience that in times of crisis, market participants usually put their money in US Treasuries. So what made them do the opposite this time around, do you think?
That's a very perceptive question. In the last financial crisis, treasuries were a safe haven, yields dropped, and they stayed low. And in this financial crisis, yields dropped, they went back up a lot, they dropped again, they went back up again. There was very strong gyrations in the yields, and they were no longer, the treasuries were no longer a safe haven for investors that just wanted to store their cash in a safe, quiet place. And the big difference, as I'll explain actually on the next slide, is related to the reduced appetite of the major dealers for accumulating treasury positions on their balance sheets now that they are under stronger capital and liquidity requirements. And at the same time, a much larger stock of treasuries to be intermediated. So that's coming in the next slide. I think the numbers will bear out what I just said. The last point I want to make on this slide is that with the large growth expected in the supply of treasuries as US federal deficits expand in coming years, I think rather than going to the Fed each time and expecting it to mop up these surges of supplies, that a new market design is called for. And if I had to pick one fix, or at least one contributing element of reform, I will explain why I think a broad central clearing mandate, a requirement for central clearing very broadly in the treasury market, is the first thing on the priority list to make this market more resilient and more able to handle large flows, and also to be a safer place to do settlements in this market. So that's a summary of where we're going in the next half hour or so. I want to leave time at the end for discussion. Michal, are there any questions pending?
Right. Before we move on, there's a question on what happened in the repo market before the Fed intervened. I guess the background is whether this was a similar story as in the Treasury market.
Yeah, the repo market also had severe problems on around March 12th, 11, 12, 13, the week before. And the Fed came in and supplied massive amounts of reserves to the repo market. This had actually happened back in September, where some of you may know that the repo market in September 2019 also had severe problems, even greater problems than showed up in the COVID crisis. And the repo market problems were more easily cured because they were mainly related to an insufficient amount of reserves, that is central bank deposits, to manage the liquidity needs in that market. Whereas the Treasury securities cash market, the problems did not go away very quickly, as I'm going to show. So the repo market cured in 2 or 3 days. The cash securities market, it took a few weeks, and a much bigger and more serious problem. So this is I think, the main story of what happened, and the main wake-up call for the need to redesign this market. And I'm going to take some time to explain this chart because there's a lot here, but I think it's worth going through it carefully. So first, on the vertical axis, it's just measuring quantity of stuff in trillions of US dollars. So it goes from 10 to 20 and up towards 30 trillion is the scale. Horizontal axis is time going back to 1998 and forward with projections to 2025. The blue bars are the outstanding marketable amount of US Treasury securities available in principle to the market. Now, the Fed can purchase some of these if it wishes, but this is the stock of treasuries that are not held in government accounts, but rather can be purchased and sold throughout the market. And you can see the pattern of growth in the blue bars. It looks exponential until the financial crisis, and then it gets kind of linear, but at a much higher rate of nearly $1 trillion a year of increased US Treasury debt. And then, oops, at 2020, it spikes because of massive fiscal appropriations in Congress, $3.8 trillion designed to handle the government's fiscal needs during this massive crisis. And governments all over the world are doing similar things, like spending 10 to 20% of GDP in 1 year, which is almost unheard of. And then it continues growing at a very fast rate for the next 4 years. Those are projections based on federal deficit projections produced by a very respected group known as the Committee for a Responsible Federal Budget, which has been providing these projections for some time. Now, what that means is there's going to be a lot of treasuries that need to be intermediated. The trades in treasury markets are roughly proportionate to the stock outstanding. And so there's going to need to be a lot of intermediation in that market. But we just saw, as I explained, that the market was unable to handle the surge in this March COVID crisis. So what about the future? Well, presumably the market will be finding more and more difficulty in handling this very large flow of treasuries unless the bank balance sheets that are intermediating these flows are growing commensurately with the stock of treasuries. Now let's look at those balance sheets. Those are the red bars, and I've plotted them in total for the largest US banks using bank holding company financial disclosure. And these are the banks that do the lion's share of intermediation in this market. There are also foreign bank primary dealers, but I'm focusing on the US banks. They're the biggest participants in intermediating this market. What you can see in the red bars is that before the financial crisis of 2008, these red bars were growing rapidly. They more than tripled in the decade or so preceding the financial crisis. Why? Well, because in those bad old days, there were not much in the way of capital requirements, and bank funding costs were razor thin because there was a presumption of too big to fail. So unsecured creditors to banks would be willing to lend money to the banks at interest rates that were remarkably low considering the risks that those banks were running, enormous leverage. Then the financial crisis hit, and regulators got serious about controlling the risk-taking of the largest banks. And they imposed much stronger, and in my opinion, much better, higher capital requirements. And at the same time, they tried to eliminate the too big to fail presumption. And creditors indeed believed, or at least priced bank debt as though they believed that they might need to take a hit the next time a bank goes insolvent. So bank funding costs went up. Credit spreads on bank debt went way up, despite the improved capitalization. So between higher capital requirements and higher funding costs, the appetite of the large banks for expanding their balance sheets essentially disappeared. As you can see, post-2008, there's been very, very limited growth in those balance sheets. Now, step way back from the picture and see if you agree with me that the blue bars are overwhelming the red bars. That is, unless something is changed, the ability of these large primary dealers to intermediate this market is going to become even more problematic than was revealed in March 2020. Now, I was talking with a leading historian of the US Treasury market and central banker, Ken Garbade, who's writing a forthcoming book for Cambridge University Press on, and his book considers previous historical events in which the central bank, the Fed, had to come in and rescue the Treasury market. It happened in 1939, in 1958, and in 1970. So this is the fourth time in a century that the central bank has had to come in and rescue the ability of the dealer-based market to handle very large flows of treasuries that were causing the market to become dysfunctional. My read, based on what I've learned in writing this paper and looking at the data you're looking at on this chart, is that the frequency with which the Fed is going to have to come in and rescue the market is going to become higher in the future unless something is done. So at the end of my remarks, I'm going to talk about a key reform that I am suggesting that US regulators study, on the Treasury Department studies. Michal, are there any questions?
Right. I was about to step in regarding this gap between the blue and the red bars. So would you see a role for foreign purchases in handling this going forward?
Sorry, what kind of purchases?
Foreign purchases.
Foreign purchases. Yeah, okay, so yeah, in fact, the foreign ownership of US Treasuries had gotten very high about 4 or 5 years ago, and it's starting to go down again. And there's a number of reasons for that are mainly related to international finance. But what was particularly interesting during the March event is that if you look at foreign owners of US Treasuries, they were among the biggest contributors to the selling of Treasuries. So, and one suspects that's coming from the need to provide liquidity for their local banks and the need to support their foreign exchange prices by using their foreign exchange reserves. So my guess is they should not be relied upon as a source of buying in a stress period, just the opposite. They should be expected to contribute to the selling, and that's not going to help. In fact, it may exacerbate the problem. Anything else pending?
No, thank you. I think
we're good.
We're ready. Yeah.
Okay, so let's spend a few minutes on what actually happened in March. So this is another complicated chart. I apologize, but I want to show you the volumes of trade in this market. And first, I want to focus on the green bars, which are the volumes of trade handled by the primary dealers themselves. And you can see that they are kind of in the $2.5 to $3 trillion range per week, leading up to the stress period in March. Then in March, they basically doubled at the beginning of March and stayed very high and fluctuating until once the Fed came in and calmed down the market, as I mentioned earlier, purchased a lot of treasuries, the volumes handled by primary dealers started to subside. They're towards historical levels again. So basically, this gives you an idea of how much treasury transactions had to be handled by the primary dealer. It wasn't, the problem that I mentioned with balance sheets wasn't that they stopped intermediating, they did even more intermediation, but they reached their limit and they couldn't handle any more than what's shown without pricing the treasuries such that they wouldn't have to handle any additional flows. Now, there's a really interesting, question.
Yeah, exactly. Maybe just on my own behalf, or maybe on behalf of part of the audience, but could you spend a little more time on the plumbing of how the purchase of treasury sort of affects the bank's balance sheet, and what does hitting the limit sort of look like?
Okay, that's a complex subject, but I'll give you my best guess of what's going on here. So the banks are under several kinds of limits that could affect their appetite to handle these flows. One is traditional risk-based capital requirements. So the primary dealer flows are actually subject to risk-based capital requirements because treasuries reprice. In fact, the 30-year bond lost 10% of its market value between March 16th and 17th. So over a 2-day period, that's a lot of price fluctuation. And so appropriately, the regulators make the bank dealers provide capital against the risk that their inventories will decline in value. Second type of requirement is what's called the leverage ratio rule, which is notorious. I'm actually not a fan. I think they should replace it with higher risk-based capital requirements. But the leverage ratio rule says basically, no matter the asset, even perfectly safe central bank deposits, there is a capital requirement that's flat. And in the US, it's 5% of all bank holding company assets. You must have capital behind it, even if it's central bank deposits, treasuries, doesn't matter. Same as for a risky real estate loan. In the middle of, by April 1, the Fed decided that it would exempt bank holding companies from the supplementary leverage ratio rule, which helped somewhat, although we don't know yet how much. The study hasn't been done on that. The third type of requirement that matters for these dealers are their liquidity requirements, because when they're handling all of these customer flows, they need to demonstrate that they have enough on-hand liquidity to handle 30 days worth of flows. So the more that they commit to cash settlements and to do repos, the less they have remaining to cover the 30 days of liquidity coverage ratio, and they could be hitting those. And then within the bank holding company, there are so many different places at which these requirements are allocated that it's very difficult to coordinate across all of them. So if you were the chief financial officer of JP Morgan, you would dole out a certain amount of space on the balance sheet for treasury desks, certain amount for lending desks, certain amount for swap desks, for corporate bond trading, for options trading, for everything. And then you try to mediate the various different divisions of the bank as they ask for more or release some, but it's very difficult to do internally. So even though you see the banks having excess capital, it doesn't mean that that there's no stress on their balance sheet when they're intermediating these large flows. I want to talk about the exciting new data set that's depicted in the red and blue bars on this chart, which are now being provided for the first time beginning in March 2020. Now, rather than just relying on general primary dealer transactions, we have every single transaction in the market available so far only to the regulators. This database is not public at a transaction level, but the regulators started to release aggregate volumes at the beginning of March. Very, very timely. By good luck, we actually know the total flows in the treasury market, which are shown in two segments. One is the interdealer segment, which is kind of the wholesale market where the major dealers trade with each other and with high frequency trading partners called PTFs, principal trading firms. And then the red segment is the dealer to customer. That's where hedge funds, pension funds, insurance companies, mutual funds, foreign central banks, and others buy and sell their treasuries in the secondary market. Now, you might ask, well, how could it be that the green bar is ever higher than the sum of the red and blue bars, because primary dealers are only part of this market? That's just an artifact of the way that the Fed shows the primary dealer transactions. If it happens to be with another primary dealer, it gets counted on both sides. So that double counting can make the green bar look bigger. But basically, you can see primary dealers are most of it. And the pattern is massive flows in March, and then heading back towards normal once the Fed came in. Now I'm going to talk just checking how we're doing on time, since I'm, oh, good.
Halfway.
Okay, so we have some time. Any questions pending, Michal? Good. Okay, just to give you an idea of the financing needs of the primary dealers, there is a data series available from the Federal Reserve Bank of New York that shows how much securities they obtain financing for every day. And you can see what happened in March. Their financing needs soared from under 2 trillion to, I don't know, over 2.3 or so trillion dollars, which is a lot of additional financing. So that it implicates either capital requirements or liquidity requirements. So that's an additional stress on balance sheets. And it's starting, as you can see, into May, it's starting to come back down. It's not quite towards normal yet. The market is still not fully functional. This is a stunning chart that I got from a speech of Lori Logan, who's the head of the open market trading desk for the Fed at the Federal Reserve Bank of New York. And it's indexed at the beginning of the year to 100. So these are all relative to the start of the year. And what you can see is nothing much happened until the end of February, and then all hell broke loose when bid-offer spreads, these are the bid and ask prices that dealers offer to their customers on Bloomberg. Those bid-offer spreads went up by a factor of 12. That's almost, I think it is unheard of. And then once the Fed swooped in, the bid-offer spreads headed back towards normal. There's going to be more research forthcoming on this soon, I understand from my contacts. So we'll know more details about this soon, but the pattern is very clear. Bid-offer spreads were so wide that basically dealers were telling their customers, we really don't want to handle your request for trade, but if you insist, here are the very wide bid-offer spreads at which we're willing to intermediate more treasuries.
And actually, from your previous chart, it seemed like many customers were willing to take it.
Absolutely. This 2 charts ago, yeah, volumes in the market, because there was such a strong demand to liquidate positions, volumes were still very large. It wasn't like the dealers were turning away customers entirely. And in fact, just this morning, I read that the bank dealers made a lot of money in March on this trading. Okay, now let's look at market depth. And we can see that not in the dealer to customer market, but in the interdealer market, where the dealers trade with each other on BrokerTech. Also in that market, they trade with the interdealer brokers, who are just middlemen between the dealers, and they trade with high frequency trading firms that are called PTFs. But almost no traditional buy-side investors like mutual funds, pension funds, insurance companies, foreign official sector accounts, or anything like that. So this is basically the internal or inner tier market between the dealers, where from the dealer's point of view, this is a way for them to lay off their excess inventory with other dealers before it gets further intermediated back to customers. And it's while it's in this interdealer market that it's building, the inventories are building up on dealer balance sheets. What you're looking at on the vertical axis in millions of dollars, this is a chart that I got from Josh Unger at JP Morgan. You're looking at the total amount in millions of dollars available at the best 3 price levels on the bid and on the ask side on average in the broker-tech limit order book market. So 150 million, which is a typical number, 150 to 175 million, that is the amount of treasuries that are available if you want to buy at the first 3 available price ticks, which are very tight normally. And then, or it's 150 million is the amount available if you're willing to sell at any of the prices within 3 ticks of the mid quote. What happened? Well, when all hell broke loose in March, the depth disappeared. You can see it goes from like 180-ish million down to more like 10 million. So more than a factor of 10 loss of market depth. That was true not only in New York, which is the black line, but also in London and also in Tokyo. So around the world, the ability to get liquidity for your treasuries basically disappeared.
Before we move on, maybe a question from audience. As far as I recognize someone actually working at the Fed. So what would explain why the imbalance on dealers' balance sheets could not resolve through price adjustments by market forces to a new equilibrium? The presumption that there would be sufficient interest by buyers at higher yields if dealers could realize temporary losses from accumulated positions instead of waiting for the Fed to intervene, and leading to the ultimate question, so was moral hazard also involved?
Well, this goes back to the conversation that Michal and I just had a moment ago. It wasn't as though the dealers said, we give up, we're not going to do any more trading, and we're going to wait, we're going on strike until the Fed comes in. The dealers were trading, they made really high profits, they handled a lot of volumes, but as the flows got bigger and bigger, their ability to expand their balance sheets, take more risk, meet the higher capital requirements on short notice, manage their liquidity needs on short notice, just disappeared to the point at which, at the margin, additional flows that they were willing to handle, they were only willing to handle at very, very large bid offer spreads and in small amounts. So the dealers were fine because they were taking care of business and they were doing the right thing for their shareholders. It wasn't that they were misbehaving in any unprofessional or unethical way. It's just that they ran out of space and priced accordingly. And the Fed did the right thing too. The Fed swooped in. I think I have a slide on that. I'm going to move to that slide. The Fed swooped in and bought, as you can see in this picture, hundreds of billions a week for several weeks, totaling between the point at which things really went to hell for the next 3 weeks, the Fed bought $1 trillion of treasuries. So the market was able to continue functioning because the Fed was basically taking stock out of the market. It was removing the flows from the market so that the remaining flows could continue to be intermediated by the dealers. The Fed called this action providing liquidity to the market. I'm not sure I would characterize it that way. Basically, I would say it was removing supply from the market, not necessarily in a way to set the yield at a lower level, but just basically to take supply out of the market. Now, of course, it had the effect probably of setting the yield at a lower level as well, but that wasn't the main point. I'm just watching the time very carefully because I want to make sure we have time to talk about the mitigating factors. And I think in light of that, I'm going to skip over this cash futures basis, which showed basically an enormous arbitrage that was not taken. And actually the unwind of this arbitrage contributed to the dislocation in the market. You can read about that in an excellent paper by Andreas Schrimpf, Hyun Shin, and Vlad Sushko at BIS. And they kindly gave me the data with which to plot these basis numbers. But it would take me a good 5 minutes to describe the basis trade and why the unwind happened. So I'm going to skip that. And I'm going to go ahead, talk briefly about just the blue series on this chart, which is called yield curve noise. This goes back to a paper by Hu, Pan, and Wang that was published in the Journal of Finance in 2013. I was actually the discussant for it at NBER. It's an amazing paper that hasn't gotten enough attention. It's now become the benchmark measure of illiquidity visible in the shape of the yield curve. And it's used by, it was used explicitly by the Fed as a guide to its purchases. And it's used explicitly by all the major banks as their measure of yield curve dislocations. The banks call it RMSE, or root mean squared error, because that's the metric that's plotted on the vertical axis in blue in basis points. Now I need to tell you what that metric means. It means that if you look at the root of the mean squared error of yields that you see in the market relative to the yields that you would have for a smooth yield curve, the actual yields are off by about a basis point at the beginning of the year, which is kind of typical. And then in mid-March, when everything went bad, yields were off by around 3 basis points on average, which in Treasury land is an enormous amount of yield curve noise. It means the shape of the yield curve was bent all over the place, and particularly off the runs were mispriced. I talked about the purchases of the treasuries. Is there a question?
Yeah, so is it actually, does it matter, or in which direction these deviations were mostly happening?
It is interesting, and it's related in part to the cash futures basis trade, that a lot of the off the runs were especially mispriced relative to a smooth curve. But it doesn't really matter whether they're too high or too low. If you're looking at this measure, it basically says there are opportunities to arbitrage that are not being taken. It may not be that it may be that they're not being taken because the bid offer spreads are so wide and the market depth is so low. But basically, there are opportunities to make very good risk arbitrages that are being left on the table because the market is relatively dysfunctional. 3 basis points is a lot of mispricing for treasuries, which is supposed to be the most liquid market in the world. Okay, now I'm going to talk about, in the remaining time, I'm going to talk about a proposed element of a redesign of this market that may be able to set the foundation for handling the massive flows of treasuries that we can expect in the next 10 years as the US federal government runs up ever larger deficits, which need to be financed with more stock of treasuries. So as those flows build up, I think I've made the case that dealer balance sheets are not the natural place to warehouse those episodic stress flows that we're likely to see every few years, and that we need a firmer foundation for this market. And I'm going to propose that one way to do that, the one that I think has been most popular among practitioners as a proposal, is to improve the central clearing of treasuries transactions. Now I'm going to explain the existing state of central clearing and then the proposed state. First, the existing state. So what you're seeing in this diagram is a schematic, obviously not realistic, but designed to illustrate how central clearing is currently done in the US Treasury market. The blue dots are the customers of the dealers. They are not connected to the central counterparty, which is shown as the red rectangle in the middle of the diagram. Rather, the major dealers are connected to the central counterparty. And when two dealers trade with each other, that's shown as a dotted line, they immediately novate their trade to the central counterparty so that the two dealers are no longer facing each other for settlement. They're only facing the central counterparty. And that has a number of advantages. First, it lowers counterparty credit risk exposures. It makes the market more stable. It makes the market more transparent to regulators because they can look at the CCP and its safe risk management practices rather than chasing around all of the dealers. But for our discussion today, one of the most important functions it serves is to net down the total amount of deliverable securities and receivable securities that each dealer needs to handle. So consider, for example, dealer one. That could be Mikhail, who has just bought from me, dealer two, let's say 150 billion of treasuries. and has just sold to Björn, let's say $130 billion of treasuries today. And so he's on the sending or receiving end of $280 billion of treasuries today with those two counterparties. And his balance sheet space has been taken up in terms of liquidity demand and counterparty risk exposures for one day until the trade is settled tomorrow. But when he novates the trade to a central counterparty, the 150 subtracted from 130 is his net position with the CCP. He only has a $20 billion position with the CCP. So all of a sudden, the balance sheet space that he uses is collapsed. Now, of course, that's already happening today for a significant amount of primary dealer trading. But if you look at the caption to the figure, for all firms facing a counterparty on a transaction, only 22% of the time is that counterparty settlement novated into a central counterparty for the US Treasury market. That is 77.6% of the transaction exposures are not centrally cleared. And that's because this use of the central counterparty is not regulated, and it's done to the extent that the dealers prefer to do it. Now, of course, it's fine that private sector actors should do what's best for them, but there's a public coordination issue here, which suggests that these green dots and the red rectangle are not internalizing the cost to the world of not having the other 77% centrally cleared. It doesn't matter that much to them. In fact, it may even benefit them if it means that all trade flows must go through the green dots. So in terms of incentives, this could be a market failure that might be cured with a mandated use of central clearing for all active market participants. That means everyone that's trading more than a given amount of treasuries per year must develop a method for clearing their treasuries transactions with a central counterparty that's approved and regulated probably by the Fed or by the Treasury Department or the SEC. The regulation, by the way, in the treasuries market is kind of murky. And you can see all of these dotted lines that connect everybody to everybody are now being converted into positions with the CCP. That has netting benefits, but most importantly for our story today, it reduces the reliance of the market on dealer balance sheets. So that's, after carefully considering this and reading congressional testimony, government reports, and private sector reports, including the Treasury Market Practices Group document that I cited, that is the first thing that I think regulators should do, or at least should conduct a serious quantitative analysis, cost-benefit analysis of doing in order to improve this market.
So that might be a good moment. Yes, there's actually a coordinated influx of two questions, which are around the clearing and settlement. So one question is, what happened to the use of the CCP during the COVID-19 crisis? Did it change from its usual level, and in what way? And the related question is, has there been failure to deliver during the COVID period? So were these settlements actually delayed or failing more than usual?
To my knowledge, there's no systematic data on how much actually gets novated to the CCP. The data that I provided from the TMPG were proprietary data that were collected for the purpose of their study. And I don't think there is an ongoing data series. Now, if I can find one, I will let you know. But one should imagine that since if you think of this as wiring or plumbing for the system, since the plumbing didn't change during March, I wouldn't have expected a significant change in the proportion of transactions volumes that got centrally cleared. There would be no reason that I can think of to expect a different proportion. Other than one thing, which is that the high frequency trading firms in the interdealer market in March reduced the proportion of their trading in the market a lot, and they were not centrally clearing. So I guess that means that if the rest was being done by primary dealers, which is a reasonable presumption, and they continued to centrally clear at the same rate, I guess that is a reason to believe that central clearing went up in March.
And on the settlement issue, is there anything that can be said?
On settlements?
Yes, whether they failed more than usual?
Yeah.
Or?
Boy, that's a perceptive question. I do have a diagram on that. Settlement fails. And so whoever asked that question has a pretty good insight into how the Treasury market works. Indeed, the settlement failures went from 75-ish billion to an order of magnitude of 300 billion at the height of the problem. Now, these settlement fails are not, they are not an insolvency failure where the counterparty has gone bankrupt and you'll never get your money, but rather the counterparty has failed to deliver the securities on time and the commitment to deliver is now delayed with a penalty. But it is a sign of increasing delivery stress in the market and perhaps some reduction of liquidity in the market. But I'm still trying to disentangle exactly the implications of these fails. But whoever asked the question had a very good insight. Yeah, settlement fails did climb dramatically. Okay, now we left off here, and when I talk about this with others, in fact, one of the commenters to my paper said, well, is it possible to clear this much? The Treasury market is huge. Could you possibly clear this much? And I went to the largest US volume equity, which is the SPDR SP500 ETF, to look and see how much is the gross settlement risk in that market relative to US Treasuries. Now, these are scaled by one-day return risk, because that's the settlement risk that the CCP faces for the blue line, which is the SPDR SP500. Almost essentially 100% of these trades are cleared at the NSCC, the National Securities Clearing Corporation. So in terms of one-day settlement risk, there's roughly 3 billion at the peak of the crisis in the SPDR equity contract that was centrally cleared. In fact, it's even more than that because equities clear on a T+2, two-day settlement risk. So there's, if you think about the two-day settlement risk, there was more than what's shown in the blue line at risk of settlement failure. By the way, there were no settlement failures. The red line is what would have been the, or actually in terms of bilateral settlement risk, what actually was the bilateral settlement risk based on the same trace database that we now have, and shows substantially less risk to be cleared than for the SPDR SP500. So it is a manageable thing to do. But the flows, I don't want to understate the ease. I don't want to understate the difficulty of doing this. There is a significant expense, capital commitments to the clearinghouse, infrastructure costs, liquidity commitments, personnel expenses, all of those things are expensive. So upgrading the market, as I've suggested in this diagram, would add expense. And my view is it's better to pay more expense on an ongoing basis to have a safe, resilient market, rather than save money on a daily basis, a few pennies, and then suffer the wild swings in market functionality that we saw in March and that I expect to see in years coming forward unless something is done. So that basically ends my prepared remarks, and we can talk for the remainder of time on whatever you like.
Great. Well, first of all, thanks a lot for these very timely and unique insights. I, for one, feel much more educated about what's going on and also what might be going on in the future. And so the CCP issue seems to be getting attention in the audience. So you spoke about costs last, and so there are two questions which I think related. That in Germany they are working, or maybe have even established an instant settlement system, and would that basically eliminate the need for a CCP? So maybe you want to take that first, and then
Yeah,
the other question.
it's a great suggestion. It was suggested by a commenter, and I take it very seriously. It is something that should be looked into as to whether it's possible or not. I asked one of the world's experts on this, who I can't name, whether it's possible to settle treasuries instantly or at least same day so as to reduce the settlement risk. And might that relieve the need that I described today for introducing a clearinghouse? And the answer is, it would be very difficult, but not necessarily impossible. So technically, it would require a re-engineering of Fedwire securities, which is the settlement system for the Fed. That's on the technical side. And then on the financing side, it would mean that anyone trading securities today, buying, would need to line up the cash financing to pay for it today, as opposed to the current system by which I trade the treasuries today, and when I need to settle my purchases tomorrow with cash tomorrow, I have a day to line up financing in the repo market, which I'll typically do tomorrow morning first thing. So the opportunity basically to figure out how much financing I need the day before I need to have the financing is an enormous advantage in the market today. If you can dispense with that and get instant settlement, it would mean that this problem that I've described would be alleviated. There would be the trade flows would reside on dealer balance sheets for a much shorter time. That's good, but it would require very, very substantial re-engineering of both the mechanics of settlement and also the way that liquidity is obtained for financing the purchases of these securities.
All right, thank you.
Great question. Great question.
All right, and in addition to that, so is the fact that treasuries pose much higher exposures compared to IRS, which I take to be interest rate swaps, have a bearing on the costs of central clearing?
It's a lot different. Swaps are, well, by the way, swaps did get the same mandated central clearing treatment that I am currently suggesting for treasuries after the Dodd-Frank Act. For those of you that are not aware, all around the world, not just in the United States, standardized interest rate derivatives, which is a $300 to $400 trillion notional outstanding market, were all centrally cleared. I looked at the data this week. 91% of US interest rate derivatives are centrally cleared. So that's a major success story, going from near zero to 91%. It is possible to do in the swap market. I think it would be equally possible to do it in the treasury market, but the costs and benefits are somewhat different. In a case of a swap, it's long-term exposure. For a 10-year swap, you have counterparty risk for 10 years. For a cash treasuries transaction, you have counterparty risk for 1 day. So the length of the counterparty exposure that needs to be handled by daily remargining and all kinds of risk mitigants is different in the swap market. What makes treasuries harder, on the other hand, is that you need to pay for it upfront with a lot of cash. And in the swap market, I can just say, I'm entering the trade. I don't have to, the initial value of the swap is zero. I do have to come up with the cash for 1 day of margin payments. So that's a much lower cash commitment. So as I mentioned in looking at this diagram, the management of the central clearing of treasuries, I think, is no more difficult in principle than handling US equities. The main difference is that the flows are lumpier.
Okay, thank you very much. And as we are nearing the end, it's very fitting to consider some, let's say, more longer run questions. So one is whether you could comment briefly on further market structure reforms that might improve resilience as a next step, for instance, all-to-all trading. And perhaps together with that, I can take the other one with a blockchain-based system. Would that have a similar benefit?
Okay, so let's do all-to-all trading. the prerequisite to all-to-all trading is broad central clearing. So basically this system needs to be set up before you can do all-to-all trading. And that's why I'm proposing this. My guess is that if you set up broadly mandated central clearing, as shown here, that all-to-all trading would probably follow, because once everybody is centrally clearing anyway, it's easier to arrange for all-to-all trade. And all-to-all trade would be more efficient in terms of market structure, market design. As for, whether it will actually happen, I don't know. That's a different question. It's an issue that I raised in an expert report that I wrote recently in swaps market litigation, where I suggested that both central clearing and all-to-all trading would improve market efficiency in that market. So I expect the same thing would apply in the treasuries market, but I think proposing both of those at the same time might be a bridge too far. And people might say, wow, you want to do all that in one redesign? Just by proposing central clearing, I think all-to-all trading becomes possible and may happen on its own.
I see.
When you asked me about blockchain, so right now the blockchain could be used to do security settlement, and it has been tested for doing security settlement in the government securities market in Singapore, at the MAS, in Hong Kong, at the Bank of Canada. The Fed has not tried it yet. In Switzerland, there are internal private blockchain settlement systems for government securities trade, and they do economize on the intraday settlements, but it's pretty technical, and I don't think it's actually going to change much in terms of the main concerns that I described today of market illiquidity on a broad basis.
Okay, thank you. And perhaps before we let you go, one more possibly perceptive question. So in the unfortunate case that the CCP proposal does not get traction, can we expect non-primary dealers to take on a larger share of trading volume? And if so, would that lower the ability of the Fed to intervene in the market, given that these non-primary dealers generally don't have access to Fed facilities?
That's a great question. So when purchasing Treasury securities, the Fed is able, I think, to easily expand its mandate beyond primary dealers. It's not like the recent COVID crisis emergency lending facilities. The Fed could buy Treasuries through any bank in the country already, and banks can buy them from others pretty easily. So I think it would not be a problem in terms of the Fed's reach. I'm not sure what would happen in terms of if no reform was made, as the market got bigger and bigger, it's likely that we would basically have no problems at all most of the time. And then every few years, we would have a big problem like the one that I described. And the Fed would swoop in and buy a whole lot of treasuries. But I don't think that's a good market design. The wobble in the treasury market in March, I think, is eroding at the edges, reliance and trust in the world's safe haven, the U.S. Treasury market, and it shouldn't be a frequent, shouldn't be more than a few times a century that this sort of thing happens.
I see. Do you have time for one more question?
Yeah, sure.
Okay, great. So the question is, would you say that enabling all-to-all trading in the Treasury cash market, like it is in the Treasury futures market, is the sort of first-order importance question? And with the CC clearing or central clearing, one way or one step towards accomplishing this?
Well, it's not only a step towards it, it's a necessary prerequisite. You can't have all-to-all trade unless you have central clearing. The two don't go together. You need a standardized product like treasuries, and you need central clearing, and then you should be good to go. Will it be more important in alleviating the concerns that I raised today? Yeah, the more all-to-all trade that there is, the less trade is intermediated on dealer balance sheets, The dealers still need to be there to handle the very lumpy flows. But a lot of the flows can be shredded and split across time and across exchanges, like in the equities market. And we would need somewhat less reliance on dealer balance sheets, and that would go a long way towards curing the problem that's illustrated in my very first diagram, which is this one, which is that the dealer balance sheets are not growing commensurate with the amount of treasuries that need to be intermediated. So that all-to-all trade would help. But as I said, I'm not going to attempt to push for a combined reform in one step, because I think it's a bridge too far. And just getting this first step done, which is a necessary prerequisite, would also improve resilience in the market to settlement risk, and I think improve transparency in the market. So it's worth doing on its own, even if you didn't have all-to-all trade.
Okay, well, thank you so much again, Darrell. It seems like we are on the cusp of huge changes in a huge market. And we all feel very privileged to be able to hear about it firsthand from you, being at the forefront of these proposals. So again, thank you for the great keynote session, and thank you for joining the conference. I hope you find time to maybe tune in for over the next few days for some of the other research that's being presented. And otherwise, yes, best of luck with these efforts and with putting them to the policymakers.
Well, it's for me to thank you. It's just been such a pleasure, Michal, to be able to talk to you and your participants at FFI2. And I am planning to stick around and watch some of the presentations over the next couple of days. You have a great program, and so it's a real honor to have had the chance to speak today. Thank you very, very much. I really appreciate it.
Thank you. Glad to hear that, and have a nice rest of your day.
Thank you.
Thank you.